How are you, folks? Enzo DiCasanzo, clinical professor of economics and finance at St. Peter's in Jersey City. And I think that was just the 8th week. Yeah. Or no, yeah. That was just the 8th week. So October, the week of the 17th, which ended on the 21st, which is Friday. So we're going to start the 24th, which is next week. And then a week after that's Halloween. So keep that in mind. And please, no tricks. I'd appreciate no tricks. But I'll tell you a story at Rutgers in class. I'll tell you some stories. What they used to do with Halloween. They used to play games. They'd tell people the class was canceled and silly things like that. So anyway, but yeah. So today we're going to talk about deductions, right? Or actually gross income. We spoke about adjusted gross income. Now talking about gross income. We'll have a adjusted gross income Excel example, and then we'll talk about deductions specifically, and then there'll be a second video on tax deductions and whatever the sixth and last tax assignment for the semester will be coming next. So let's start presenting and get to it. So okay. Yeah, actually, before we start the lecture, I just wanted to quickly look at this. This is the survey for the University of Michigan, the consumer sentiment survey, and actually, there's 3 pieces to this. And this thing, if you just look at, I mean, I can look at it and say, yeah, this was created long ago. This was done with like a typewriter or something, if you could believe it. And I guess they just left it how it. This was probably pasted up there like on a piece of paper. They cut this out and pasted up there. This stuff was created long ago when it was a different sort of desktop publishing was a little bit different than it is today. Supervisor's ID. You could see the way this was all written in a very industrial way. Like it says University of Michigan 2015, but and even if this is made with a modern with a sort of a modern system, a modern a computer system or a modern publishing system, but it's still it's still sort of in the older vein of the way because documents don't look like this, all the boxes and the very rigid type and things of that nature. But you can see there's a couple pieces to this. What did I do? There's like a financial part, a business conditions part, a personal wealth part, all those types of it's got a bunch of different pieces to it. Yeah. Better, worse off. Yeah, there's financially is some your personal finances, and then here business conditions are next. So the financial space, the business condition space, economic policy was next. So interest rates, that's a third one. Prices are a fourth one. And then the overall outlook, again, prices again. Your income. So yeah, I remember I broke this up into pieces a couple years ago. Real estate, the real estate markets. I sort of scrolled through it and got all the topics. Gasoline prices, there's a couple on gasoline. Okay. And then home prices, real estate, that kind of, selling homes, the price of homes, how many homes, renting, what you think, how you think your neighbors are going to be doing. It's in the North Ward of Newark, not great. I don't think too many of my neighbors are doing that well, which is unfortunate. But that's just sort of what that is. Yeah, how the stock market's doing, diversified stock funds, and how investments are going to do, or that kind of a thing. So yeah, so there's a bunch of pieces to it, and that we've been having that conversation across sort of at the private equity firm, and some of you guys are asking me about it. So but that's important, and so obviously the sentiment for next year is across the board from Elon Musk and Jamie Dimon and Google and Amazon and all these other Meta and all these other companies, Walmart. They're all thinking similar. Dark, even though technically by my definition we're in a recession already, but somehow the federal government is saying no, we're not somehow. But okay, but the facts are what they are. Anyhow, so yeah, so today will be gross income, deductions, and then we'll work on the adjusted gross income Excel model. Okay, so gross income for an individual is gross pay. It's a paycheck. Total earnings before taxes and other deductions. Okay, other deductions. So we'll keep those words in mind, including income from all sources, not just employment, and it's not limited to income received in cash. It also includes property or services received. So, like I said, so as your accounting knowledge, how you're going to break things up is extremely, extremely, extremely important. So don't forget that a good sense of revenues and earnings, profit margins, all those other kinds of things that matters a lot. So for companies, gross income is interchangeable with gross margin or gross profit. The company's gross income found on the income statement is the revenue from all sources minus the cost of goods sold. That's for like a goods company, like a Walmart or a Home Depot or Ford and ExxonMobil, where their inventory is gasoline and they're selling something. It's not for a law firm or a hospital or something. Even though you go to a hospital, they charge you per the Band-Aid. They charge you for the roll of tape that they use, if you can believe it. But anyhow, so gross income for individuals consists of income from wages, salary, plus other forms, pensions, interest, dividends, and rental income. And again, the folks who took the macro course with me a couple of years ago, you remember we had the aggregate model for disposable income, and it had all of these transfer payments and things of that nature. It had all these pieces on it, earnings from investments and things, which is your pensions and things like that. Excuse me. Gross income for a business is total revenue minus cost of goods sold. Individual gross income is part of the income tax return, and certain deductions and exemptions becomes adjusted gross income, then becomes taxable income. Yeah, so that number 3 basically says it, right? You start with a gross income. You've got some now the exemptions thing. We don't have exemptions anymore, so this was probably written a while ago. The source of where I got these notes, but there's certainly just a deduction and an exemption are very similar. Then you get an adjusted gross income, and then you get a taxable income kind of a thing. So then there's other adjustments that can be made to that number before you whittle it down to taxable income. Which again, so you have really everything in between. And again, I'm not really a tax guy, but everything in between. You start with earnings, and you end up with taxable income, and above the line, below the line. That's for the tax, the specific tax people. There's people who just like what we've done these first 8 weeks. There's people that's all that they do. So always keep that in mind. I'm just giving you a picture of this. We looked at some stuff from the journal, and I use sort of my math skills to sort of give you guys some background on this. But there's people who specifically do only this, and they're not worried about the macro economy. They're not worried about doing a business valuation or deal structures or banking. They just care about taxes. It's municipal or state or companies or whatever it might be. Individuals may also be required to report gross income when attempting to secure a loan. Okay, that's an important thing. I had to do that. My parents better had to do that. Businesses often use gross income instead of net income to better gauge the product-specific performance of a business. To better gauge, I like that. And like I said, you guys have these notes on the web on the Blackboard site. Different components of gross income with respect to an individual and a company. They determine gross income by consulting a recent pay stub or calculating the hours that they worked in. So again, do we have pay stubs anymore? When I was my first job, I remember there was a check and had a listing of all the deductions and what was sent down to Trenton, all these other things. Alternatively, I wonder if I'm going to get Social Security based on that. I wonder, maybe. Well, alternatively, gross income of a company may require a bit more computation. The individual's gross income is used by lenders or landlords to determine whether a person is a worthy borrower or renter. And folks, like I said, that I've stopped telling this story because it's fading into the last decade. But there was a student a number of years ago. Now, actually, it was a while ago. I remember she was in my class, and I don't know, she was in some sort of romantic relationship with some guy, and he was going to give her a car, and they loved each other, and this and that, and they were going to be together, and all these stories. And what he basically did was he went to his buddies on Route 1 somewhere in New Jersey, I think maybe in Linden or Elizabeth or something like that. And his buddies had a used car business, which God knows, when I say used car, we can put that in quotes. And some of you know what I mean by that. And he said, "Oh, I'm going to give you a car." It was like a BMW or something. It was a really expensive car, whatever, $70,000 vehicle or something. And these were folks that weren't really at the level of earnings to have something like that. And he had her sign the loan papers, and she thought she was signing the. I guess they shuffled it all together. They shuffled in the loan payments and the ownership payments. So the car was in her name. It was registered in her name, but she was also liable for the $50,000 to buy the car, whatever it was. But it was a big number. It wasn't some small little number. And the problem with that was after the romance went south, and which in a very short amount of time after that. Um, so the guy's buddies got credit for selling a car. The creditor or whatever got credit for making a loan. The auto loan guys got a commission for that. The guy selling the car got, so a bunch of people got commissions, and the student was stuck with bad debt that she couldn't pay, and then the car got repossessed, and now on her credit rating for a number of years is that's going to show. So when she's looking for a job as an accountant or something, that's something she may have to explain to a potential employer somewhere down the road. So in other words, that stuff. What am I telling you the story for? It's not nothing. Your credit rating is not nothing. It's going to pop up, in your lives. Not necessarily. I mean, certainly for a loan, but it could pop up in other places for state of New Jersey employment and things of that nature. So you want to keep that in mind, okay? That it's not just free money, and don't go to friends who have car dealerships. That now the car dealership is gone down there, and she had no real recourse, and just a big mess. A naive kid who got taken in about 4 or 5 different ways, which is unfortunate. So anyway, so when filing state income taxes, gross income is starting point before subtracting deductions to determine the amount of taxes owed. Fine, but yeah, so it's gonna your credit rating is an important. Component of your financial profile. So a company calculates gross income to understand how the product specific aspects of business are performed. Using gross income and limiting what expenses are included in the analysis, as a company can better analyze what is driving this success or failure. For example, if a company is interested in knowing how specific product line is performing, it does not want to see the company's rent expense included in the performance as unrelated administrative sort of overhead number, right? So you want to just focus on operating numbers, and that's certainly an important piece of the puzzle. It says the approach to determine gross income for an individual is a little bit different than a company. Both the computations are similar, but each type of entity uses different classifications of income and expenses. So for individuals, and the gross income metric used on the income tax return includes not just wage or salary, but also other forms of income, tips, capital gains, rental payments, dividend, alimony payment, pension is. So now when you read through these lists, you have some idea when you're looking at the tax instructions what all that means and how all that plays a role. Because if you're earning from it, you got to include that. So after subtracting the above the tax line deductions, the result is the adjusted gross income. So this above, I'm not even sure myself. This above the line, below the line, that's the tax lingo. Ask a tax person what that really means, and they'll tell you. So there's some income sources that are not included in gross income for tax purposes, but may still be included when calculating gross income for lender or a credit. So yeah, that's something else you have to realize. The IRS has their set of specifications. The SEC has their set of specifications. The banking or lending industry might have a third set of specifications for you to profile your income. And you got to realize you got to set, and they may all be different. Okay, so you got to be able to satisfy that. So common non-taxable income sources are certain Social Security benefits, life insurance payouts, some inheritances or gifts, and state or municipal bond interest. And that's a whole conversation. There's and we've discussed it in class. There's all sorts of publications from the IRS that go into the details of that. For non-tax purposes, individuals can usually use their total wages as gross income. When applying for a loan, individual gross income will equal the amount of money the individual earns prior to any taxes being deducted or any expenses having been paid. Some lenders may require the use of AGI to standardize how gross income is calculated. So you have to have that number to work on some of the deductions for your medical and dental expenses, and we discussed some of that in class, and I'm sure a whole other bunch of computations are going to require that. So gross income is a line item that sometimes is included in the company's income statement. It's generally not displayed, though. It's calculated as gross revenues minus cost of goods sold. I'm saying if it's not displayed, if the company doesn't tell you what it is, if Home Depot doesn't say it, then here's the formula for that. And again, the accounting material that I taught, we would use this exact formula. COGS is cost of goods sold, and all that. Okay. Okay. Yeah, we're going to go to deduction in a second, but just hang on. Okay. So it's referred to as gross margin sometimes. Also, there's a gross profit margin, which is more correctly defined as a percentage and is used as a profitability metric. The gross income for a company reveals how much money it's made on the product or service after subtracting the direct costs to make that product or to provide the service. So business. So I was reading through this morning how Google and Meta and Amazon and all those Microsoft, all those kinds of companies, how they're laying off. And I think something that I read consistently is we're going to put resources and human resources and capital resources in the businesses that take advantage of the opportunities that are going to be most profitable. I think I've read that a couple of the CEOs of some of the major companies, so all the technology companies, Apple, whatever it might be, Home Depot, whoever, Walmart, they've all basically said something very similar, that we're going to put people and capital resources in an area where we can have the greatest, the greatest profitability for the company. So there you go. And so again, so everything that you do, and I was having a conversation with somebody about employment just a little while ago. Everything that you do helps you. It's you gotta have the long term view of being educated, being able to have a good conversation about business and about the economy and about markets with people, those kinds of things. So business gross income can be calculated on a company-wide basis, on a product-specific basis. So like Microsoft has about 4 or 5 divisions, and believe me, they're calculating gross income per division and per product line, and they're the PlayStation thing or whatever it is. The video game system that Microsoft sells and all the other things. They're what is it, Sega or something? I forget what it is. But I remember I taught the Microsoft 10K, the annual report, a couple summers ago. So as long as the company is using the chart of accounts that allows tracking of revenue by product and cost by product, the company can see how much profit each product is making. Okay. So gross income metrics factors in the direct cost of producing or providing goods and services. It does not include other costs relating to selling activities, administration, tax. So yeah, the overall running the business costs aren't included in there. And this is a comparison of gross income and net income. They're not the same by any stretch of the imagination. Gross income is way up on the income statement. Net income is the bottom line, which is the profit line. And both terms explain how much money a household is making or taking home. For an individual, net income is the total residual amount of income remaining after all personal expenses have been paid for. Personal net income is calculated through the total amount of revenue earned less the amount of personal expenses. We all make that computation: our phone bill, gas and electric bill, property taxes, those kinds of things. Fixing the car, right? This differs from gross income, which limits what can be deducted from the overall or from the total revenue earned. An individual's net income more closely resembles a final paycheck amount, although the individual is likely to have more expenses can be deducted from the pay. The paycheck is a good example of their revenue being reduced by cost. Well, I mean, look, you're going to have a certain amount of earnings. You're paying a certain sort of income taxes that are sent down, and federal taxes that are sent to Washington, sent out to Trenton, or sent up to Albany, or something to that effect. And then you have your expenses, post cashing your check or post payment. Then you've got to cover property taxes and things. Now, you may work someplace where there's like a bill paying. I'm sure if you work for a very large, Fortune 500 company, there might be something like that where as you get your paycheck, the company, certainly through a bank, will have sort of an expense plan where it pays for your property tax and your car insurance and all those types of expenses in an automatic way. I'm sure that we're to the point of sophistication where we can do things like that. An individual's net income is more closely resembles. Okay, the final, we talked about that already. For a business, net income is the total amount of revenue less the amount of expenses. These expenses include cost of goods sold. However, net income also includes selling, general, administrative, tax, interest, and other expenses are not included in the calculation of gross income. So, in words, that's basically the income statement right there that's described. Gross income is a much higher view of a company, while net income incorporates every facet of cost. Because gross income incorporates both revenue and specific expenses of driving that revenue, gross income is often a better gauge for comparing to similar companies as it analyzes how efficiently each company generates a profit. Okay. And revenue and expenses. Okay, fine. So, and yeah, so this is this our example? 75,000 interest. Yeah, I think this might be our example. And we'll get to this. Yeah, this is our example. Okay. Like I said, let me just finish the talking here before we hit this. But you have an example where you have 75,000 annual salary, $1,000 in interest from a savings account. You're collecting 500 in stock dividends. You're receiving 10,000 a year from rental property. you have a gross annual income of 86,500, and then you can calculate the monthly gross, dividing that by 12, which is about 7,200. Imagine the same individual paying $1,500 a month in rent, $450 in student loans, $300 towards an auto loan. All these expenses are excluded from the calculation of gross income for non-tax purposes. So then the gross income only considers the revenue earned. Okay, so in regarding to the individual's federal income tax, let's imagine the individual pays $500 a month in student loan interest for the prior year. So while filling out the tax return, the student loan interest is an above the line deduction and used to factor in the adjusted gross income. So in other words, you can deduct. Now, if you look at this, and this is painfully wrong here. I don't know how we now, I don't know if this is 500 for the whole year. Perhaps it could be that's 500 for the whole year, but let's see, how do we do that? Yeah, yeah, you want to be careful. Is that 500 the whole year, or is it per month? So when this is subtracted out like this, see how it says 86,000? We looked at it a little bit differently. We said or we took the student loans. This is interest from the prior year. So yeah, if you can deduct your loan payments, I think we have the numbers that we figured out here. We have the 86,500, and it's 50. So we got it down to 81,100, right? Because we took it as a monthly and multiplied by 12 months. So now is this just the interest payments? So individual pay for and student loan interest for the prior year? Yeah. No, if that's correct in terms of interest, then you're okay. I deducted the student loan amount. I deducted all the payments from that, not just the interest. But we'll see. I'm saying, but regardless of which one of those you can or can't do, it's really the process that we care about. Some of this has changed, over the years. So just keep that in mind. So just sort of breaking this down. If it's $500 just in student interest over 12 months, whatever that number is, $60 a month or something like that. No, is it 60? No, it's going to be what is that? 500 by 12. Yeah, about 40. It's like $40 or something like that. $42 a month or something. Let's say 42. It's 41.67, $41.67. Okay. But so that's so, but again, if this is the cumulative for the year and interest payments for the student loan, those can be deducted to determine the adjusted gross income, or also now again, I guess depending on the tax code, you could deduct those $450 per month student loan payments. You may or may not be able to do that. Actually, as we're sitting here, let's check that out. Can you deduct? Yes. So depending on the income and certain limits, that's why I did it. Yeah, here's the IRS topic 456. As a student loan interest you pay during the year on a qualified student loan includes both required and voluntary prepayment interest. So that's the interest. You may deduct the lesser of 2,500 or the amount of interest that you actually paid during the year. The deduction is gradually reduced and eventually will be eliminated and phased out when your modified gross income amount reaches the annual limit for your filing status. Yeah, this is student loan interest for you person, your dependent when you took out the loan for education or academic. Yeah, fine. Okay. So that we all know that. And also benefits for education. Then you have the instructions. So there's a couple, there's a few forms here. 970. We're going to open that in a new link. So earning credits. Yeah, this is student loan interest deduction. So limits, no double, you can't deduct interest on student loan and then paid by your employer. Okay, so you can't do a double benefit of this. And there's a limit here. It says you can reduce your income subject to tax by up to 2,500. So you got to be careful with that. So yeah, so what I did in class, I'm not saying it's wrong, but I think it may have changed, from past. Yeah, because see what I took the 450, and then so that's more than 2,500. Okay, so that could be a problem with that. But like I said, we're showing you the steps on how to deal with all this. So There's no double benefit. Fine. So it says this one took a solely pay educational expenses. Qualified education. So yeah, it's got to be a qualified educational expense. Yeah, it's an interest deduction, not paying back the principal. So yeah, you got to be careful with that. I got to be careful. You got to be careful. We all have to be careful. Like I said, it says don't include as interest origination fees. Okay, fine. Yeah. So, and you can see this is 87 pages long. So you can't do double benefits. Yeah, no, but there's exceptions. Yeah, here's the motley guys. Yeah, this again, this is simply about the interest. So, and yeah, there's an example here, and it says the deduction allows you to write off up to 2,500, but because the tax deduction is not a credit, it reduces your taxable income instead of the tax bill. So if you're in 40,000 this year, you qualify for the full 2,500 loan interest deduction. You would subtract the amount from your 40,000. So yeah, so you've got to parse. It's not the principal, right? It's not the principal. So see, there's an example here. Yeah, which I didn't work out the dollars on this, but yeah, something just happened. Yeah. So there you go. Like I said, so it's just the interest. So I did that. I deducted the principal, but that's fine. That's fine. So and obviously this 54 is bigger than what we were talking about. It's good. Like I said, the more times you sort of look at this, the more times you say, hey, are we getting this right or not getting this right? So so there we had the personal one, and then we had a business gross income example where you had net sales of 97 billion for Apple. The company spent 49 billion to generate the product, spent an additional 5 billion on services as a part of the cost of goods sold, and by subtracting Apple's net sales by the total cost of goods sold, Apple reported a gross income of $42 billion. It incurred 6 billion of research and development expenses, 6 billion for selling general administrative costs, and about 5 billion for income taxes. All three of these expenses are excluded when calculating the gross income, but a company's gross income only include the company's net sales less cost. So there were other expenses involved in the business, but we care about how we get the product out the door is really what we care about. Okay, it says how can I calculate personal gross income? What's the difference between gross and net income? How do you calculate gross? So yeah, we'll answer. Actually, what we'll do is we'll run to the Excel right now and work this out, and I can go over sort of some of the, and then we'll go back to those questions, and then we'll hit deductions. Okay, and like I said, in some years I think the principal was deductible, but now it's not. So now it's just simply the interest. And let's see, was student loan ever tax? Yeah, the deduction it's limited. Yeah, it's limited to the 2,500 is what it is. Yeah, so we're here. So that's like I said, hey, that's what we're doing in the course. So what I did in class, not that it's wrong, but it's not current. I'll say it like that. It's not current, but that's fine. So anyhow, so looking at this, so annual salary is about 75,000. Type that in. Interest from savings account, 1,000 a year, and these are all pluses. Stock dividend, 500. Rental property income, 10,000. Right? Again, we discussed this stuff in class. Okay. So the gross income from this is simply the sum. And again, like we discussed in class, you don't want to just do this, something. You don't want to do that, right? You want to just get just the cells that you need, and that's how you get your 86,500. You had some student, again, not under the current rules, but at one time, of these expenses, 1,500, 450 minus 300, like that. So the loan payment expense, in terms of the monthly expense, that can't be deducted. The rent expense can't be deducted. And you have a monthly student loan, but this can only be deducted up to 2,500. Okay, so yeah, this is out. Okay, no, student loan interest. Interest payment expense. That's how what it should have said. Yeah, you got to be careful with this stuff. So I'm saying if that's the interest that was paid per month, but actually that amount of interest, that'd be a pretty big loan. If I'm saying, but we'll take that for, and but again, also, so as we'd mentioned previously, you had the 12 here. Remember this? You had the 12 number or whatever. Center this thing. Okay, remember this from previously? Say equal 450 times that 12, 5,400. And again, just theoretically, that's the only piece you could deduct. So you're just going to add these two. But this is limited. This is really limited to this number. It's really limited to that. So it would really be this. Yeah, that's really what it is. Okay, because this is too much. This is too much. So that's we're again based on topic 456, right? Okay, and we'll get to that. So that's the limiting number up there. So, but in class, we multiplied that by 12 and got this number, which is too large. Okay, but this says for the year. So, like I said, but like I said, you got to be careful with your numbers and how you deal with all this. So, yeah, and this would be 84,000, right? And see, that's why. So now, if you program this where it would follow your numbers here, this is 5. If it would follow your numbers, then you would those changes would have been automatically made. So let's not be overly concerned about that. Okay, the other piece of this. So again, so if you have these, and actually with these, I'm just going to pick these off if you don't mind, just for speed purposes. We're just going to copy and paste these. This is the 97 billion. This is the cost to generate the products. This is some of the cost on services. That's a part of goods and cost of goods and sold. Okay, so the gross income is 42 billion. Yeah, that's 42 billion. Yeah, 40. Yeah. Because this is in millions. This is with 6 zeros. And there's some other expenses that you can't deduct to compute gross income. But like I said, though, you got to know your tax code and what you're computing gross income from. You got to know all that stuff. Like I said, but this was just some light gross income computation. There's nothing heavy duty about any of this. And actually, just as we're here, we're not going to do this today, but what's coming next is we're going to have the 3 taxpayer version: itemized deductions, no deductions, and then standard deductions. We're not going to do that today, but maybe tomorrow morning or Monday morning, maybe if I do a second video this week, we'll go over that. But that's, so there's one more of these coming, and then instead of 80,000, this might be 250,000, and we'll do the same example with 3 choices. We'll sort of stick with that. Okay, but like I said, folks, rely on rely on the federal IRS website. So how can I calculate personal gross income? It's a total amount earned before taxes or other deductions. Usually, an employee's paycheck will state the gross payment as well as the take-home pay. If applicable, you'll also need to add another source of income that you've generated. Net income is the money that you effectively receive from the work that you do. The take-home pay for individuals. For companies, it's the revenues that are left after expenses have been deducted. This is different than gross income, which only includes cost of goods sold and omits all other types of expenses. This one was, how do you compute this? So if you have $500,000 in sales and $100,000 to compute the products, your gross income would be 500 minus 100, which is net 400, which is gross income. What is my monthly gross income? So you just take your check and look at your check amount. All right, that you earn each month, and it'll likely be different the amount of money you take home as received payment directly from your employer. The gross income can be found on the pay stub as the total amount of money that you earned. You get a W-2 in January, and that has your earnings and what was, the different taxes already paid. So it sorts through what the company did on your behalf in terms of satisfying your tax liability. And gross income is the total amount of income a person or company has earned before deductions against that income. Okay, total amount of revenue before subtracting expenses like costs, interest, and taxes. We're going to, tax deduction is a little bit long, and we talked about this in class, but this will be a part of the next video. So the next video will be tax deductions, and our last bit of what we're going to talk about today is going to be the so gross income we did. And then we're going to do deductions today, that we did. And that'll be another video. Okay. Yeah, so deduction is an expense that can be subtracted from the taxpayer's gross income. So you can see how this conversation, lends itself well to the gross income lecture. Deduction is an expense that can be subtracted from a taxpayer's gross income. Okay. So if you're in 50,000 a year and you make $1,000 donation to charity, that's tax deductible. Your taxable income goes down to 49,000. That's an example you can sort of hold in your hand and say, oh, I understand what this is. Okay. The deduction is an expense that can be subtracted from taxable income to reduce the amount owed. Most taxpayers take the standard deduction when they file Form 1040. We've had a video about 1040. Taxpayers who itemize deductions must use Schedule A, Form 1040, to list all of their allowable deductions. And the standard deductions have increased steadily since the passage of the tax cuts, since the federal tax code was changed in 2017. Okay, and so we're sort of summing up everything that we sort of learned here. So taxpayers in the United States have the choice of claiming the standard deduction or itemizing their deductions. Claiming the standard deduction is easier, requires less paperwork, less record keeping. The IRS has revamped the forms, and now we're not using the 1040A or the 1040EZ. We're not using any of that stuff, but we have Schedule A for 1040 is an attachment to the standard 1040 form, and are required to fill in a list of their allowable deductions and keep the receipts to prove if they're audited. So the longer the form is used by filers who have substantial deductions that add up to more than the standard deduction. So an itemized deduction is an expense subtracted from the adjusted gross income, which reduces taxable income. Therefore, the amount of taxes owed. Common itemized deductions include interest on a mortgage loan. So again, you have to distinguish between interest and the principal payments. All right, interest is being deducted, not like what I said in class, not where you're deducting your principal payments also. Please consult a tax professional. And again, you want someone who's got it at the tips of their fingers every time, whether a standard deduction or itemizing works for your financial situation. Since the passage of the Tax Cuts and Jobs Act, the standard deduction has increased over the years to help keep pace with rising prices called inflation. And we've seen these over and over and over again. What the 2021 standard deductions are, what the 2022. So hopefully you're remembering these at this point. The current standard deductions are a significant upgrade from the levels before the Tax Cuts and Jobs Act. For 2017, the standard deduction was 6,000, and for single filers, and 12,000 for married people. So you can see this number went up significantly. If you opt to claim the standard deduction, there's still some itemized deductions you can claim on your income tax return, including eligible student loan interest and tuitions and fees. Deduction is different from tax credit, which is subtracted from the amount of taxes owed, not from your reported income. There's both refundable and non-refundable tax credits. A non-refundable tax credit doesn't trigger a refund, but a refundable tax credit, which I think we discussed in class, can trigger a refund. So again, if you have $500 in income and you're eligible for $600 credit, you'll get a $100 refund if it's refundable. If it's non-refundable, you won't get a check from Washington. Okay, some businesses qualify for tax credits, which offset or reduce the company's taxes owed to the federal government, but business taxes or credits are designed to encourage a particular behavior that benefits the overall economy, building a factory or upgrading something, some kind of business or something to that effect. 1 second. So tax deductions reduce taxable income. Tax credits reduce the taxes owed. Okay, so you got to keep that in mind. Okay, so there you go. So I know this one wasn't too long. This was just about maybe a half an hour or so. Okay, but we covered sort of the three areas. So business owners have much more involved process for taxes than the tax on business profits, not on proceeds or revenue. So that means documenting their cost of doing business to subtract that from the gross proceeds. That's why you'll see these little sort of tax services in the cities, like in Newark and Patterson and places like that, in Elizabeth. You can, if you're running a small family business, you're a contractor, and you want to do things the right way, you'll go to the to these accountants and get your paperwork worked out, and keep records and things of that nature. The process is the same for the smallest business and large corporations. But the corporations have accounting departments to take care of the paperwork, and businesses are required to report all the gross income and deduct business expenses from it. So the difference between the two numbers is the business's net taxable income. Thus, the business expense work in this way is similar to deductions. Although the process of tracking expenses can be burdensome, the total amount of expenses can reduce the company's taxable income substantially, thus lowering the taxes owed. Okay. So there we go. We had deductions. So next time we'll do tax deductions. Will be the next lecture, and we'll work on the three models. Okay, and then we also talked about gross income. Okay, all right, folks. All right, folks. We'll see you soon. Thank you.